What's up, Blue Chips? It's Tim from Volatility Trading, and we have another video here for you today, and it's going to be about probabilities in the stock market. So, let's get to it.
Let's get to it. Let's get to it.
Let's get to it. All right, traders, Probabilities 101. The importance of understanding the probabilistic nature of active trading cannot be overstated. Many new traders refuse to consider all possible outcomes of their bets and instead choose to exclusively see what they want to see. This happens all the time. I even do this every once in a while. Failing to recognize and accept the possibility of both positive, neutral, as well as negative outcomes, which leads many traders to stick with trades that just aren't working. Other effects of not foreseeing and accepting all possible outcomes are dangerously adding to losing trades, leading to catastrophic losses. You've seen me do it. Paralysis and relying on hope to save their trade. People do that all the time. We call them investors. And forcing trades and fighting the market, MTSI, believing that they are right, MTSI. If nobody knows what I'm referring to, go check out my MTSI video. Even though that the trade is becoming increasingly more and more expensive, there couldn't be a better example than MTSI. Go check out that video. Probabilities form the basis for trading rules, alerts, edges, and very important methods for emotional management. Before we explore how to deal with probabilities in our trading, let's look through an intuitive example to form the basis of our understanding. If you're not familiar with probabilities, there is exhaustive information on the web you can easily find and invest significant time researching and learning about probabilities. Fortunately, you do not need to know the details to understand the concept. Probabilities simply associate a number with the likelihood or chance of something happening. For example, if you roll a standard dice, you have an equal chance of rolling a 6 as you do a 2. Each number has a 1 in 6 or 16.6% chance of occurring. What is always critical to remember, however, is every possible outcome has an associated probability. Even very remote and unlikely outcomes can occur. To help understand how probabilities relate to trading, let's take a little bit of a detour first. Let's begin by considering the game of Texas Hold'em. Some people just call it poker. This will help be a good example as many are already familiar with the game. If you're not familiar with Texas Hold'em poker, I'm sorry. This is not going to be a tutorial, and if you want to learn more about the game, there's plenty of information out there on the internet. So we know there are many possible hands you can be dealt, as well as similar possibilities your opponents can be dealt. Ultimately, the only fact that you know is the relative quality of the hand you are holding. For example, we intuitively know the odds are in our favor if we are holding any of these 4 hands. So we have 4 of a kind, full house, flush, and a straight. Anytime you make one of these hands, you know that the probability of you winning that hand is much higher. So you have a good chance of winning, but we should also know that all of these hands can be beat. You may be surprised if with your 4 of a kind that you lose because your opponent was holding a straight flush, but you knew all along that this was possible, and maybe in retrospect, kicking yourself for going all in. Likewise, we have little chance of winning if we draw a 7-2 offsuit, but there is a chance, however slim, that this could be the winning hand. To win at poker over time, however, focusing exclusively on playing top hands and folding low probability ones is the key to success. In active trading, there are also good hands as well as bad hands. The good hands, i.e. high quality setups and signals, provide high probability outcomes time and time again. Bad hands, low quality setups, and or no signal provide random, often negatively biased outcomes. Bad hands absolutely include random, emotionally driven trades, similar to playing good hands in poker. Focusing exclusively on high-quality setups puts the odds of success on your side. But with the odds on your side, even the best setups do not have to work. Your pocket aces and pocket kings, pocket queens, ace king suited, all of those aren't always going to win. In reality, you never know what is going to happen with this particular setup, but you may know what is likely to happen. For example, you may know the last 10 times you have seen an ascending triangle. 7 of them were potentially profitable and 3 were not. Here's 10 examples. We have an ascending triangle here. It worked. We have another ascending triangle. This one did not work. Here's another one. This one did work. Another one that did work, or 3 and 1. Another one that worked, 4 and 1. Another one that worked, 5 and 1. Another one that worked, 6 and 1. Another one that worked, 7 and 1. Another one that didn't work, 7 and 2. And this is another one that failed as well, 7 and 3. So what happens next when you encounter a similar setup? As you can see, we cut this one off because it's impossible to say with absolute certainty what will happen next. Anything can and will happen. However, you can confidently say that the setup is more likely to be successful than not. Even if you don't know what is going to happen, the odds are in your favor. If you don't know what's going to happen, how can you possibly trade without a framework that accounts for any possible outcome? It is the uncertainty, the probabilistic nature of the stock market, which drives the need for trading rules, risk management, and an emotional management structure. Because you never know if this time will be a winner or a loser. Every possible outcome should be accounted for in your trade plan before, I cannot stress this enough, before you enter a position. Unfortunate outcomes are part of the process. How you manage their effects emotionally and financially is what separates the consistent traders from the 90%ers. Understanding the probabilistic nature of the stock market and consistently applying risk to high-quality setups is what gets you into the 10%. So some key points to take away from this. The stock market is inherently probabilistic. All outcomes are possible for any series of events and should be appropriately anticipated. Uncertainty drives the need to have a risk management and emotional management framework. That's all I have for you guys. Like and subscribe if you haven't already. Appreciate the support as always. If you have any questions or comments, leave those down below, and I'll see you in the next one. Peace.